Doctors have some of the highest incomes in America, yet many retire with less than teachers. It's not because we don't work hard. It's not because we don't earn enough. It's because of one thing: where you put your money. Now let's think about it. The average physician will make about $8 to $12 million over the course of their career. But if your asset allocation is off, you could lose decades of freedom, peace, and options. Today, I'm breaking down 9 advanced rules of asset allocation specifically for physicians, dentists, and high-earning healthcare workers. Principle number 1, diversification is your first line of defense. If all your money is riding on one horse and that horse trips, you're done. Let me break this down. Stocks crash, but bonds might hold steady. If the US market underperforms, international stocks or emerging markets could outperform. Real estate hits a lull, you have T-bills, CDs, or cash reserves that can help to stabilize your portfolio. Remember, diversification requires that the assets chosen have low to zero correlation, ensuring that they are driven by different factors. Diversification doesn't guarantee gains. What it does is limits losses. And as a high-income professional, your goal isn't just growth, it's longevity. So your portfolio should be designed to survive chaos and not just chase returns. Now, taking us to principle number 2 is asset allocation, not stock picking, drives your returns. The Brinson study from 1986 found that 91.5% of your portfolio's performance over time comes from your allocation, not your ability to predict market winners. Morningstar tested this again in 2019 with real portfolios, confirming the same. Allocation is king or queen. So here's what that means. It's not about buying Apple at the right time. It's about having the right ratios of stocks, bonds, real estate, and cash. You are not Warren Buffett. And even if you were, he'd tell you to get your allocation right, okay? Principle number 3, your risk tolerance should drive your allocation, not your ambition. If watching your portfolio drop 20% would ruin your week, you need more bonds. But if you can stomach those short-term drops to chase long-term growth, a heavier equity tilt might be right for you. Think of it like this. Portfolio A, for example, with 80% equities and 20% bonds might drop 25%, and portfolio B with 50% equities and 50% stocks drops 12% during a downturn. So your allocation should match your financial pain tolerance. The best portfolio isn't the one with the highest returns. It is the one that you can actually stick to through a storm. Now, I want to mention a caveat here, because if you are 30 and you choose a more conservative approach, the pain that you might feel might be dampened now and worsened later when you have less assets to draw from in retirement. So determine your risk tolerance and then explore it to ensure that you can achieve both long-term and short-term goals. Okay, speaking of time, principle number 4 tells us that your time horizon matters. Time is your secret weapon, and it's one of the most misunderstood concepts in investing. The longer your money stays invested, the more risk you can take. A 27-year-old internal medicine resident with 30 years before retirement could go 90% stocks and really ride the wave. But a 59-year-old cardiologist who wants to slow down in 2 years, you will need more cash and short-term bonds to protect your timeline. Time horizon isn't just about age. It's about when you need the money. So for all you FIRE people out there, remember to adjust your time horizon based on your intended use of income in retirement. Now, most people obsess over what to invest in: stocks, bonds, ETF, real estate, but very few think about where to place those investments. That is a big mistake, because principle number 5 teaches us that different accounts have different tax treatment, and asset location is very important. And if you ignore that principle, principle number 5, where you put your money, you're likely handing thousands or tens of thousands to the IRS unnecessarily. So here's how the taxes break down. Bonds generate regular interest income and have lower growth potential for stocks. So that interest is taxed at ordinary income rates, which could be 35 to 37% for high earning professionals like myself. If you're a physician or a dentist and you're really not strategizing around taxes, you can lose a lot of your bond income to taxes. So you want to keep bonds in a tax deferred account like a 401k, where you defer taxes until retirement and when your tax rate may be lower. Growth stocks and index funds, if you hold these in a taxable brokerage account and sell after a year, you will pay long-term capital gains tax, which is usually much lower, 20%, than your ordinary income tax. So this is ideal for taxable accounts, especially if you're using the buy and hold strategies. REITs often pay high dividends that are taxed as ordinary income, and growth ETFs can appreciate quickly. So if you hold them in a Roth IRA, all that growth and income is tax-free forever. No capital gains, no dividend taxes. And this is huge for long-term wealth building. And why this matters to you specifically is as a high income earner and healthcare professional, you're likely in one of the top tax brackets. That means every 1% of tax drag matters more to you than someone earning $60,000. So asset location is how you protect your investment gains, optimize your long-term compounding, and avoid unnecessary taxes that chip away at your returns. It's not just about choosing the right investments, it's about putting them in the right buckets. A well-located portfolio can add 0.5 to 1% of your annual return. And over 20 years, that's potentially 6 figures of extra wealth just by being smart about where your money lives. Now, number 6 is all about rebalancing that keeps you on track. Let's say that you start with a 70% stocks and 30% bonds. After a market surge, it might shift to 85% stocks and 15% bonds without you even realizing it. Now you're taking way more risk than you signed up for. That's why rebalancing, checking in once or twice a year is so important. Most 401k providers let you set this on autopilot. And rebalancing isn't about market timing. It's about staying in alignment with your original risk profile. So think of it like adjusting your treatment plan. You don't wait for a crisis. You check in regularly. And principle number 7 is asset allocation is personal. Your asset allocation should reflect your actual life, not just your income. Most financial advice assumes everyone has the same needs, goals, and risks. But as a physician or a healthcare professional, your personal circumstances can dramatically impact how much risk you can afford to take, how much liquidity you need, and how aggressively you should invest. Let's break this down a bit. Do you plan to retire early or work part-time someday? If your goal is more freedom sooner, you'll need to be a bit more conservative or have a flexible investment strategy that provides access to funds earlier than a traditional retirement timeline. You also may need to have heavier cash or think about diversifying your income that generates additional sources of income during this retirement period. Are you someone who's supporting aging parents or planning too soon? Caring for family members means unexpected expenses, so you might want to increase your emergency fund, have greater liquidity, or more insurance protection, right? Do you have kids that you're saving for college? If so, then you might want to access a 529 account and prioritize putting money into that opposed to a taxable brokerage account. And will you be moving to a lower paying role or more flexibility? A lower income in the future affects how much you should save now. So you may need to front load your investments or prioritize tax advantage accounts differently. 2 doctors that have the same income can have completely different portfolios. So you wouldn't want to follow a stranger's diet plan. So don't copy their portfolio. And principle number 8 is passive beats reactive. Every year, more than 85% of active fund managers underperform the market. Why? Because they're trying to outguess something that is unpredictable. And when individual investors try to do the same, the Dalbar study shows that they consistently earn less than the actual market because they react emotionally. So the solution is to stick to passive index funds, automate your investments, and stay consistent. It is not about brilliance. It is about behavior. And Vanguard's widely cited study called Advisors Alpha, which highlights where financial advisors actually add the most value, is not necessarily through picking winning stocks, but through helping clients manage their behavior and follow a plan. So, according to Vanguard's behavioral coaching adds up to 1.5% in additional annual return. And that's more than what any investor trying to gain by picking stocks or timing the market will afford you. And that is exactly why I became a coach, so that I can help women in healthcare to stick to their financial plan, to modify their behaviors and start winning in investing and in life. Why this matters is investors often sell during a market crash, chase hot trends at the top, abandon their asset allocation when fear sets in. So for high income professionals like physicians, dentists, lawyers, one bad emotional decision like selling during March 2020 or not re-entering the market can cost hundreds of thousands in lost growth. So advisors or a coach like me help you stay disciplined in downturns, stick to a consistent asset allocation, and avoid costly emotional mistakes. The bottom line is, according to Vanguard, the greatest value of a coach isn't beating the market, it's helping you not beat yourself. And whether you have an advisor or a coach, understanding this principle reinforces the need for a solid investing strategy, a plan for rebalancing, clarity on your goals so fear doesn't make the decision for you. And principle number 9 is liquidity should be part of the plan. Can you access your money when you need it? That is liquidity. And this matters more than you think, especially when emergencies come up or when life throws you a curveball. Your emergency fund should be in a high yield savings account. If you're thinking about purchasing a new home in 2 years, you want to make sure that you have cash equivalents that can help you to stay liquid for that purchase. In some retirement accounts, the money is locked up. And if it's locked up when you need it, you're either paying penalties or selling at a loss. So don't fund short-term goals with long-term tools. And if you learned something, then I want you to put it in the comments. If you have any questions, put it in the comments so that we can work together and figure out this thing for your success. And if you haven't already, subscribe to my channel and watch this video about 10 assets to put into your Roth IRA that will help you to determine which assets to choose. All right, well, I will see you in the next one. Bye-bye.